everything changes.
Welcome back to our lesson on data and insight. Now we're in the home stretch. There's 2 more lessons after today's. If you remember last time, we talked about the importance of taking action on our marketing decisions, and we stressed that it requires a deep analytical build-out to not only be informed, but also to be able to take action and respond appropriately. Now, we also agree that there's a ton of information coming at you each day in this digital age of communication. And that can be good and bad and sometimes overwhelming. Point being is we need an intelligent way to actually process all that information. So, of course, we turn to that group of effective and confident marketers along with the process that we founded our company on, and we learn how to create a usable approach and method. Now we're going to take a look at some data analysis and data summation in this lesson today. Please try not to get lost in all the busyness of the numbers and trying to figure out where all the numbers are coming from. I know that for some producers that are data junkies, they want to dig into all this, and other ones get overwhelmed or even bored by it. For the sake of efficiencies and time, I want to keep the discussion high level, and I'll point to the most important part of the number, and of course the message behind it, which is how to use data when you have the right data in place to actually make more mindful and more math-based decisions. So keep in mind, let's not get lost in all the busyness and try to focus on using the information. That being said, if you have interest or need or desire to understand some more of the data I'm presenting today in a deeper capacity, reach out to us. We'd love to share that information with producers we have relationships with, and we'll be willing to engage with you. Also, keep on the look for upcoming educational videos that we'll put out. In addition, each month we host a live webinar called a Lunch and Learn, where we recap the current USDA report and actually present some of this data in a more focused and refined view. So stay tuned and look for opportunities to enroll and sign up for the upcoming webinars, as well as look for educational material from us. Okay, let's step back into data and insight. So when it comes to analyzing data, the most common approach involves gathering as much information as you can digest, and then what? Well, if you answer correctly, you said use confirmation bias to filter it. Yeah, that's usually what we end up doing, right? Usually unintentionally, but it's what we do. We allow our bias filters to only see what we want to see. Now it's time to take a page from that effective and confident marketer's playbook and look to build in some replacement behaviors. So rather than just making decisions on outlook and opinions and then allowing our personal bias supported by the information we allow in, we need to actually develop a process that is based on something stronger and more beneficial. How about math? And more specifically, how about probabilities? So let's start there. Let's define probabilities and opinion, and then we can ask ourselves a question. Okay, so to define probability, of course, the definition, the extent to which something is probable, the likelihood of something happening or being the case. Synonyms: likelihood, chance, feasibility, possibility. Now let's define probability for comparison's sake. Opinion for comparison's sake. Opinion, a view or judgment formed about something not necessarily based on fact or knowledge. So synonyms are belief, judgment, assumption, feeling, and viewpoint. So there we define probability and opinion. Now ask yourself this question: when it comes to something as important as your revenue, as your income, which definition seems to be a better fit to use? Right? The group of effective and confident marketers use probability. Think about this. We use probability in almost all important decisions we make. And in life in general, I guess in general terms, it's how we operate. Usually subconsciously, but it's how we operate. So when it comes to something as important as your income, as your marketing, as your revenue management, we need to use probability and avoid using opinion and outlook. Okay, for the next 4 slides, we're going to take a look at some of the results of the probability studies and potential price range criteria that we have developed to guide our strategic-based decisions and actions. And I'll explain what we're looking at each one, but then again, draw your focus to the end result, which is how do we use that information to better prepare. Now, if you develop a strong curiosity or need for validation on the methods and understand some of the data, just reach out to us and we'll be happy to explain. Other than a few proprietary methods and pieces that we have developed, most of this information is really available to anyone. You just need to take time to organize and process it and then derive the probabilities, which is what we've done. And as a reminder, don't get bogged down trying to read and understand everything. Just focus on why this is important and how this can be beneficial. Okay, so starting with the corn carryout projections. Each year, of course, the USDA does us a favor by putting out all the data each month in those reports. And whether we believe in that data or not, I think we need to accept it because it is what the trade will go off of each month to adjust price. So what we do here is we take a look at some variability in how things could change going forward, not trying to outguess or predict, but preparing ourselves for what's all possible. So it starts over here on the right-hand side. Here's where we bring in the current USDA beginning stocks and then all the different demand pieces. So we have a number for demand, we have a number for beginning stocks, and then that's baked into behind the scenes the carryout projections, which is saying, hey, for this year's crop, we have acres that could vary and we have yield that could vary. Well, we know acres probably won't change much anymore. That's been pegged recently at 97 million acres. And now we know trendline yield is pegged at 178.5. Obviously, yield is what could change, okay? But going back to this, where the blue lines intersect, that's saying based on current situation, supply and demand, with current new crop production, based on these numbers, 97 million acres and 178.5 yield, we would end up coming out of this year with a 3.327 billion bushel carryout. And then the bottom chart is the same data just expressed in stocks to usage versus ending stocks. So what this gives us then is the ability to adjust either acres or yield and say what kind of sensitivity will the market have if we see a drop in yield. Now, if we saw a drop down to 171.8, not a disaster of a crop, but certainly off trendline projections, that would bring ending stocks down to 2.7 billion or 18.4. So we can assess over time, a 3 or 4% change in stocks to usage, but still a number above 15%. What's the likelihood of a rally and how much could we expect based on other years where we've seen changes of a similar percentage, right? And realizing it would really take something devastating to get the crop to fall down to enough of a drop in yield and thus ending stocks or stocks to usage to actually have a really major rally coming on our hands. But it's not impossible. There's still a year ahead of us and crop development ahead of us. So just gives us a bit of sensitivity on what type of changes could happen and what that might mean, and then it gives us the ability to prepare ahead of time. Okay, here's a quick look at the probability for a price bounce based on studying the old crop corn year to where a bounce could happen into this current year. So this is always looking back and saying, where did the December contract low come in 1 year, and then what's the percent probability of a change in price heading into the next year. I mean, for comparison sakes, we'll look at percent bounce for the March contract, the July contract, and then December. So again, comparing it to December low from last year to where this year's highs could come in, or feasibilities of a price rally could come in. So looking at the last 20 some years of data, we can assess that based on the average change from December low to March, July, and December high of the next year, based on those actual raw percentages, it would give us then some vision going into this year saying, listen, there's a 65% chance that March corn of this year would get to 425. It also means, based on that data analysis, that there's a 90% probability that July and December corn would both hit 425. Now, there's time for that to happen yet. But you notice to get much above that, to get to 450 or higher, the probability greatly diminishes. Right now we get down to closer to a coin flip. When you're between 50 and 60%, it's basically saying, hey, flip a coin and we'll see what happens. Here's the thing to look at and to remember. Nowhere on here do you see 100% probabilities. And that means there's always low odds or low probability something will happen. And those are the things that need to be prepared for. Not enacted upon until the market gives a signal, but certainly on the radar so we don't get caught by surprise. Now, this doesn't help us outguess or predict exactly where the market's going to go, but it helps give us some range of where we should start pricing at. When we know there's a 94 to 70% probability, we want to make sure in those ranges we're prepared to respond when the market hits those. And again, not holding out glamorous hope for something major to happen to see 5, 5.25, 550. Again, very low probability that's going to happen, but certainly something that's not totally out of the equation with the right mix of news and weather. So again, just giving us some sensitivity in what's more likely, develop a plan for that, and then prepare and start developing contingency plans for other scenarios. Now, to refine that data, let's take a look at a more closer example, or maybe a more focused example on the July contract. So taking roughly that same type of data, breaking it down to a post-planting low of 1 year, and then looking at the spring high based on the July contract of the next year. In the last 10 years, over here on the right hand side are kind of where those percentages broke down as far as percent change in price from the low of 1 year to the July high the next year, or the high the next year based on the July contract. Outside of 2011, where there was over 100% change in price, a major rallying year, we look at all the other percent changes, and they all seem to be kind of comparable. But let's factor that through and look at some averages. Well, over the last 10 years, the average percent bounce has been 33.9. If you throw out the 2011 year, kind of a bit of an outlier being that big of a rally, the average percent change in price from, again, low of the 1 year to where the July high comes in the next year is 25.1% change in price. If you actually broke it down a little bit tighter and just look at the last 5 to 6 years, you would see that there's about a 20% recovery. And then down here highlighted is the smallest percent recovery in the last 10 years, and that was 2018, 13.5%. Okay, but obviously we talked about in earlier modules that the last 5 years have been kind of a compressed trading range, and that's evident here by seeing only a 20% change from low of 1 year to the July high of the next year. Again, giving us some levels to start to prepare for. Now, we take that and actually plot that on a December corn chart for this year and have some price range views. And again, not predictions, but just look at what's feasible with certain percent recoveries based on what history has told us. Well, kind of excluding these top couple here of seeing prices closer to 5, just focus on the last 3, right? A 15% recovery from harvest low of last year, which came in at 382.25, would put us at about a 434 potential price for July. I'm sorry, a 440. The 13.5% recovery would put us at a 434. And if we only got a 10% bounce, a 10% recovery bounce, that would still put us up near 420. So these things give us some potential ranges to look at making decisions, and again, basing them on what's more probable with the current marketing year and the current crop development year. We can refine and hone those in. But this is what helps us and that group of confident marketers prepare for everything and not be caught off guard. All right, data analysis is important. Developing probabilities and knowing how to respond is important. And what's even more important is developing contingency plans for all the other probabilities. As I mentioned before, we never saw 100% probability on any of those data slides. But making sure we have a plan in place for those low odds is extremely critical, so when it happens, you're not caught off guard. Remember the old Boy Scout motto in training, right? Always be prepared with math and probabilities, and avoid emotional outlook-based decisions. Rather than just gathering data to feel more in the know and smart or feed your opinion, adapt the habits of that effective and confident marketing group and lay out your action steps with probabilities and preparedness, and know what to expect and how you'll respond, and the low odds and the high odds. Again, well-rounded, well prepared. Okay, well, hopefully I impressed upon you that more data isn't the answer. Using data correctly and appropriately is. Again, reach out to us if there's more clarification needed, and certainly look for some of the upcoming videos and the Lunch and Learn live webinar series. Look for emails to register for that. In the next module, we'll talk more specifically about modifying behavior, kind of lighten it up a little bit again. Our contact information is on the next slide, as always. And until next time, be safe, be well, and be mindful of how you use data and insight.